Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, instead of interviewing a special guest, what John Manfreda and I of Wall Street for Main Street are going to do is just talk about the current events and the market wrap and the things that are driving the specific markets that we think our listeners should be interested in. So, John, we talked about the jobs report a little off air before we started recording. What's your opinion of what's going on with the jobs report that was just released on Friday?
Well, I think it's well, pretty much it shows, like, as they say, the devil's in the details. And you can tell how bad the economy is. 44,000 were in retail. 43 were in education and health, which, if you ask me, that's probably government teachers. Local, state and local, that can't afford it. 13,000 in temp help. So, obviously, these aren't high-quality jobs being created. These are low-level low-paying jobs, which there's nothing wrong with them. I'm not like a snob or anything, but this is not a recipe for a good economy or a recovery.
Exactly, Johnny. It's not a recovery, and a lot of these jobs, the retail ones, are probably not even full-time. And the ones that are full-time, you're getting paid, if you're in retail, you're getting paid about $7 an hour if you're or whatever the minimum wage is in your state. If you're lucky, you're not getting any type of benefits or anything like that. There's a lot of taxes on your wages on top of this. And some of the other job creation is going to be probably restaurant ones, so bartending and serving. And those jobs in a lot of states, you get paid $2.13 an hour. You don't even get minimum wage, and then you get tips. So, and we've outlined the problems with the minimum wage anyway. The problem is that wages, there's no way the Federal Reserve is going to be able to raise wages, and the Keynesian central planners are going to be able to raise wages. It's failed. All their attempts have. They've misallocated capital, made things worse, increased taxes, blah, blah, blah. And instead, what they've done is they've made prices rise. So you have wages stagnant or dropping because of Obamacare and all these other rules, regulations, taxes, et cetera, and then you have prices rising. So you have the middle class and the poor who are not, the poor, are trying to do an honest living and work themselves up, who are not on a bunch of government programs. They don't have the wages to go and consume or save or any of these, or invest or any of these things, and the prices are going up, so their standard of living is dropping. We need the Keynesians out of this. We need the central banks out of this. The prices have to fall. Like in those consumer discretionary items, we've been preaching this. We've gotten a lot of comments from people who don't understand this. The prices on everything have to fall. The Keynesians cannot arbitrarily tell everyone in the economy that we're all of a sudden raising the wages for everyone to $15 or $20 an hour. It will backfire tremendously. It has already backfired tremendously. They've spent many millions, if not billions of dollars on studies and reports trying to disprove fact. And, the funny thing about the jobs report, John, is that some of the excuses for the jobs report now are being blamed on a shutdown in the porn industry. Okay, I think there was, 20 or 30,000 jobs in the porn industry that stopped working for a week or two because of an HIV scare. One of the porn stars, I think her name's Cameron Day or something. This was on Zero Hedge for our listeners. And also the head of the Washington Post in charge of the economy, their economic editor, he was talking about it, and he was saying that this is the reason why the jobs report was so bad. So the Keynesians, the people in power, John, what it looks like to me is they're running out of excuses. They're blaming things on ridiculous things like a work stoppage in the porn industry for bad jobs numbers, for bad centrally planned misallocation of capital. This is why a large government, big government, running a welfare warfare state, trying to allocate trillions of dollars a year, they can't manage the economy properly. And now the price signals are getting screwed up, as we've said ad nauseum. And, the stagflation's just going to get worse and worse because most people at best are going to be lucky to find a part-time job.
Well, another thing, too, is they say this is 169,000 jobs added. Well, the reality is I guarantee you this is not employing 169,000 different people. There's a lot of people working 2 to 3 jobs. So I would like to see how many people this is employing, because I'm sure a lot of those jobs, the same person is working 2 and 3 of them. I don't see a stat for that, but I'm guaranteed.
I agree. And I agree with you, John. And that's just to pay their rent and their food bill. That's not to get ahead in life. That's just to tread water.
Yeah.
And, something else here is that the job stuff, it's just not going as planned for the Keynesians at all. And they need to get out of the jobs market. They need to get out of the economic statistics. They're lying about all the statistics. And, you know, they're creating my main point that I just remembered a second ago is the birth-death model, John. And the Bureau of Labor Statistics has this birth-death model, and every time someone gets fired from a full-time job, the model assumes that people will create a job. So how many of these jobs that they say are being created, they created as part of a formula with the birth-death model? We don't know, because they're probably not going to disclose that fully. But the birth-death model is there. Our listeners should go look it up. It is a fact about the birth-death model. It's one of the many gimmicks the Bureau of Labor Statistics, or BLS, or BS department, uses to game the GDP, employment, you name it, inflation, CPI, all those different things. So it's just ridiculous. One more point here for the job stuff, John, before we move on. Okay, let's run the numbers here. We have about 2 million people either coming over here from immigration or college graduates, right, or high school graduates who want to enter the workforce each year. Over 2 million, okay? More people per year. The amount of new jobs being created, even in, you know, these part-time retail, these restaurants, some of these other part-time jobs, they are not keeping up with the new people with the new people entering the workforce, and they are not replacing the full-time jobs that are being lost due to Obamacare, the full-time jobs that are being lost due to other, you know, reasons. Perhaps maybe robotics are replacing people, or software programs, or jobs are still being outsourced probably to the Philippines, to some of the India, to some of those English-speaking countries still. Although we are starting to get small amounts of higher-paying manufacturing jobs back here in the United States, but these are not large amounts of jobs. And those technology jobs, you know, in those really high-end industries like 3D printing, robotics, those types of things, John, you have to have really specialized skills to get those jobs.
Yeah, and yeah, that's basically it. And another thing I want to point out about the jobs report is I love how they used to give rosy jobs reports. And now that we get close to the tapering date, it's not so rosy. It just goes to show you that the government does not want the Federal Reserve to taper, and it will. And I personally don't think it will let it. They might, you know, stress test it, but you can tell from this jobs reports, it's not. It's doing what it can to prevent tapering.
Yeah, I mean, like I said in other past interviews and podcasts that we've done here and other investing websites, there are some jobs being created. Some of these jobs are higher paying, and those are in manufacturing. Some of them are starting to come back from China due to high energy costs, or we're moving here because there's lower taxes here in the United States compared to Europe, because Europe's a total disaster compared to the United States. Europe's just ridiculous. They've really screwed things up even worse than the United States in the short term. And, you know, technology. So and also the shale boom. Forgot about the shale boom. Yep. So we have the shale boom. We have the jobs growth in Texas and North Dakota, which is accounting for 18% of all the total jobs created since 2008, which is pretty amazing. That in spite of all these rules, regulations, and you know a lot of bureaucrats in the EPA and other things trying to prevent shale, right, and documentaries coming out, that we're still creating all these jobs. So the free market has, you know, adjusted, John, and figured out how to get these jobs in place. So that's pretty amazing, in spite of all the detriments, the hurdles, that the job market is still creating some jobs.
Yeah, and definitely when it comes to the shale oil, the one sector that has where employment has increased by 40% since 2007 is oil and gas. And I just want to point out, Obama was poo-pooing the types of jobs that this Keystone pipeline would create.
They're better than any job he can create.
Basically said they're not even good-paying jobs. I was like, he's the one to talk.
He can create more community organizer jobs, and he can recruit more people to get them on welfare and EBT cards. Because after all, right, as Paul Krugman says, right, more people on welfare stamps and more people on EBT cards. Let's get the number from 40 million Americans on welfare and food stamps and EBT cards to 100 million. That should improve the economy, according to the Keynesians, according to Paul Krugman. Yeah, right.
But I was going to say, the point is the Keystone Pipeline, if they approve that would actually create high-revenue, high-paying jobs. And that's actually, and it's funny, and I think those jobs will get created. It will either by rail or some other way. in the future, but that is one way to immediately boost the economy, get kids who are living at home out of the house, and that would be a big economic boost. But one other thing, and that's just what I wanted to say, is that despite all this, oil and gas, their employment, U.S. employment rate has increased by 40% since '07, and that's probably the only high-paying sector that has increased since '07. I can't say for sure it is, but
well, other than technology, John, and some manufacturing jobs that are starting to come back, some really specialized ones where maybe you're using robotics or 3D printing in the manufacturing and things like that. Yeah,
but
I would agree.
Yeah, but also let's switch topics now to the credit bubble in the auto loan sector. You wanted to go over that, so.
Okay, I heard Jim Poplava on the Financial Sense News Hour, and I love Jim Poplava. He's a genius. He's well-read. He's worked in the industry for 30 years. Excellent money manager, very bright. I've been interviewed on his program, and I've written articles on his website. But he's saying something that I completely disagree with. He's talking about all the great things about the auto industry and how they're selling cars, and he's talking about like the manufacturing renaissance here in the United States. He is talking about the shale boom in a good way, and that is great. But the manufacturing thing, I think we outlined why jobs are starting to come back, but not a lot of jobs are coming back, a small number of them, because people can, through creative destruction, there's not going to be a massive amount of manufacturing jobs coming back because these new factories are going to be built, John. They're going to have more robots. They're going to have more 3D printers. They're not going to need as many human beings as in the past on the assembly line. But now back to autos, and well, that's part because autos are manufacturing, John. But one thing about the auto industry that Jim Poplava is not talking about is that there is a huge credit bubble being reformed in auto loans, okay? A lot like the student loan bubble. I just found some research for our listeners. If you email us at wallstreetformainstreet@gmail.com, that's WALLSTFORMAINST@gmail.com. We can send you some articles on this. What it basically says, though, is that a lot of the auto loans, John, that have been given out are now 6 years or longer, and 17% of those total auto loans since 2008. And on top of this, John, there's been an 11% growth already since 2008 of subprime auto loans. These are people with bankruptcies who can't pay their credit card, who are defaulting on their student loan, who have low credit scores. So you basically have a situation where the Federal Reserve and the banks have kept credit so low for so long that the auto industry, to make their earnings look better, right, to move cars off the dealership, to get rid of inventory that maybe they overmade because they misjudged their market. And once they dump the cars, right, once they sell the car, it's not their problem because it's the financing company's problem. It's probably not staying on GM or Ford or Toyota's books for the most part. The people can go into the car lots now, and in a lot of cases, even if you have really bad credit, John, you don't have to put 20 or 30% down payment down on the car to get the car and get a loan. You can walk away, no money down, 10-year loan. You know you can't make the payments. And in a lot of cases for some of these loans, John, you don't even have to make a payment at all for a year or two. So you know you're going to default on the loan, right? Because you don't have the income, or maybe you're hoping you find that job, but people are giving you loans anyway. They're not doing what the banking system and financing is supposed to be, and this is what the Keynesians have really screwed up, and also crony capitalism with the government and bailouts, is that you're not supposed to make loans without sound collateral, without looking at the assets the borrower has, right? If they can liquidate their assets to pay back the loan, or if they have the cash flow from a job or a business or investments to pay back the loan. None of this stuff is being done to the most part. The credit standards are really laxed.
Oh, definitely. I've actually read somewhere that auto loans, subprime auto loans, you're allowed to use shotguns as down payment. Right here in Reuters, that this guy Jeffrey Nelson, he was able to put up a shotgun as a down payment in the car. So, and that's what's been happening. And one of the things is it said, thanks to the Federal Reserve, that this guy, let me look at his name, Jeffrey Nelson, has now been able to use a shotgun as a down payment as an auto loan. shotgun as a down payment for an auto loan.
And for our listeners out there, without the Federal Reserve and the federal government bailing out, the banks and the auto companies, there would be no way in their right mind any of these companies would give out loans like these. But they know that they're backed they know that they're going to get bailed out, which is why that they're giving these loans in the first place. If you know you're not going to get bailed out, you're going to do a lot better due diligence. You're going to do better research. I mean, unless you're a complete and total rent seeker at your company, but then you're like that guy at BP at the well who did really stupid orders there, and they didn't carefully set up all the safety precautions there before the Macondo well, which was the Gulf spill where BP blew up the well. But in general, though, there's supposed to be safety precautions in place, right, John, where you're not supposed to give out tons and tons of these bad loans, and that's how they're fueling this bubble again. Just like the student loan bubble, they gave student loans almost unlimited credit, knowing that the students couldn't really pay it back. I mean, if you have a degree in so-and-so background from a small-name college or something like that, and you have over $100,000 in debt, and you can barely get like a $7 an hour job, how are you going to pay back your loan? Your loan's going to double. So these car companies are going to, if people can barely make the payments, I just don't know, man. I don't know why these car companies in the long term in their right minds would do this. I'm thinking these CEOs know that these things at the car companies know these loans are going to blow up, and the CEOs are just trying to make the earnings look good, right, over the next year or two so they can cash in their stock options and get out. And they don't care about the long-term health of the company because they're taking all of this free money and credit from the Federal Reserve, from the Wall Street banks who can do fractional reserve lending. And, they're going to get theirs while the getting's good. They're going to cash out their stock options because the stock price went up, because the earnings went up, and they're going to bail out on the company 2 or 3 years from now. So that's something 2 or 3 years from now listeners should watch for. I think eventually we're going to see General Motors go bankrupt again. I think it is 100% guaranteed. It's a question of when and not if.
Well, not only that, a lot of companies, the banks do this, but I can't say for sure, but they'll take the loan and then immediately resell it or collateralize it and sell it on the exchange. So they're not responsible.
Right. They'll sell it to the stupid pension funds. Yeah, you're exactly right, John. So that's what they did to the credit default swaps, and that's what they did to the mortgage-backed securities. They dumped it right to the Iceland pension fund, to CalPERS. They dumped it to all those U.S. and foreign pension funds. And when a Wall Street salesman is trying to sell you something and you're a pension fund manager and you're not even a full-time guy, you don't have a finance background, maybe you're just managing the money like this is a part-time thing, you only spend a couple hours a week doing it, and maybe you're a full-time teacher, maybe you're a full-time businessman or something out like that, and you're going up against a really sophisticated Wall Street salesman who's trying to sell you a derivatives product like that, you're in a lot of trouble. You're not the smartest guy in that deal. You're going to get screwed.
Well, that's why our consulting firm's here.
Exactly.
So,
exactly.
Yeah, and Saudi Arabia suffered from the 08 crisis because they had subprime loans in their sovereign wealth fund. And that's probably why they're buying gold now.
Yep. And they're also maybe worried that the Petro Dollar could be in a lot of trouble, too. Let's transition. We're supposed to talk – the next topic, right, is Syria? Or are we talking about – no, we're talking about treasuries dumping. So the Saudis are probably worried about that, too. Mm-hmm. So our next topic that we want to cover for our listeners is since June, we've seen massive dumping in the U.S. Treasury market. That is, remember for our listeners out there, the rates on the 10-year got as low as 1.4%, and over the last couple months they've gotten up to almost 3%. So they're hanging around 2.8%, give or take, right now on the 10-year Treasury, and a lot of that, the main reason for the spike in interest rates is that demand is decreasing rapidly from foreigners. John, you want to talk about some of the statistics for China, Japan, and the foreigners?
Yeah, right now China and Japan have a record outflow of U.S. Treasuries, almost $40.8 billion of net selling. That's 1 month. So that right there, that's just China and Japan. That's not including Russia, who's also selling. And this is very dangerous because this can be very rapid because China and Russia own 25% of our total treasuries. And if they keep dumping on it, interest rates will rise rapidly, and a lot of companies. I think this could also send a ripple through the stock market because a lot of companies have teaser rate debt, and they'll go bankrupt. So
that's a good point, John. And one thing, either the interest rates will start to rise rapidly, or the Fed, instead of tapering, will have to reverse course and start to defend the bond market by monetizing even more debt. So instead of tapering, you could see the Fed start to buy $150 billion per month, or somewhere around those numbers, because if China and Japan and Russia and all these other guys start dumping, they're going to have no choice. Because, like you said, John, as soon as the interest rates start going up to a certain level, we could have bank failures. A lot of other corporations have leveraged their balance sheets with short-term debt. I don't think it's a smart idea, but they've done it anyway. And, it's very, very dangerous. You have a lot of things going on in Syria, too. And we'll see what happens. But things are playing out, John. We were talking about this before we started recording. Almost exactly like the financial war game scenario that Jim Rickards wrote about in Currency Wars. What you had the Chinese and the Russians, who both were running massive trade surpluses with the U.S. You had them start dumping treasury bonds massively. You had them start to put a lot of their monthly trade surplus money into physical gold, which both of them are doing. I believe both of them are buying over 50% of their trade surplus money goes into physical gold.
And Russia's open about it. Putin was bragging about it 2 months ago.
Exactly. And then on top of that, John, you have also in the currency war scenario, you have China and Russia starting to negotiate bilateral trade agreements to get around the world reserve currency and the Petro Dollar and all those things. So these are all, for listeners out there, it's one of our favorite books. It was written, I think, in 2011. A lot of the stuff is still very pertinent. It's available on Audible, audiobook, Currency Wars. It's also available on ebook. One book, Financial Book of the Year from a number of publications in 2011. Go out and read it. A lot of the things going on right now are playing out almost exactly like Ricker said. In my opinion, Russia and China are pretty much following the currency wars, especially Russia is following the currency wars playbook to a T, because that brings us to our next topic.
Oh, I want to add one thing. Even okay. Australia, they struck an agreement not to trade in U.S. dollars. Now, it was with China, but Australia, after World War II, their main foreign policy has been to align with the U.S., but on that deal, they were not aligned with the U.S., so you are seeing a lot of countries not trading with the U.S. dollars. And when Australia does it, this is like Germany, I think, repatriating its gold.
Yeah, that's a good point, John. And we don't expect the dollar to die immediately. In fact, we expect other currencies like the Japanese yen, the British pound, the euro. I really don't like how the euro's put together. And, some of these developing countries, because they've had really bad intervention central bank policy too, like especially India, which is just a disaster, those countries could fail first. And that would temporarily strengthen the dollar, but the dollar is definitely making lower highs and lower lows. So long-term trend, the dollar may not die first, as some experts are predicting, but the long-term, all fiat currencies are in a lot of trouble, and the dollar will have its day of reckoning. The dollar will probably be saved for last because it will be given the benefit of the doubt because of world reserve currency, but that's just giving the Federal Reserve and our politicians more rope to hang ourselves with. Right, John?
Oh, I definitely agree. It's definitely and that's the thing about Austrian economics is there's a lot of backlash on I would say gold and silver bugs this year because of the crash, but people forget Austrian economics is a long-term thinking. It's not a short-term. You can see a lot of them be wrong in the short term, and Keynesians, in the short term they can be right, but long-term, gold's in a bull market and the dollar's in a bear market, and that will not change.
Exactly, John. And let's talk about what's going on in Syria and the oil price and stuff like that for our listeners here. This will be the last topic we discuss before we end this podcast. What we have, let me just try to summarize this, John, the way I interpret things, and you can tell me if you agree or not. You had Russia, who is investing a lot of money into the current puppet who's controlling Syria right now, And for a while, Russia and Gazprom did not want this natural gas pipeline to go from Iran through Iraq, through Syria, and into the Mediterranean. But now it appears that their view has changed on this because Qatar, which is a large LNG and gas facility, they wanted that natural gas pipeline, right? And they wanted a regime change in Syria. So you have the Russians and the we'll say Qatarians. Yeah. We'll call them Qatarians. I'm not sure if that's right. I apologize if you live in Qatar and I botched your name. I sincerely apologize. But you have those guys who want this natural gas co-op now. It appears Russia has changed their foreign policy stance because they didn't want the pipeline originally, and this appears to be a direct play against OPEC and against the Petro Dollar, because you have the Saudi Arabia on the other side of this. You have the United States, and you have some of the remaining countries in OPEC who don't want the natural gas pipeline either. They want people dependent on oil. They don't want natural gas strengthening. And they don't want this natural – I think they view, John, this natural gas co-op as kind of a natural gas rival to OPEC. And as we all know, OPEC is one of the keys, probably the heart of the petrodollar system, because all that oil profit, a lot of it gets put back into the U.S. banking system and into U.S. asset markets to help keep our markets good.
I think this is all humanitarian. No.
yeah. The U.S. government probably gave them the weapons, right? So I mean, we gave Saddam the weapons. We gave Saddam all these weapons of mass destruction and the chemical weapons, right? And then he used them on his own people. And then when he stopped listening to us, right? Then we deposed Saddam, and then Saddam started trying to take euros instead of dollars, right?
Yeah.
To get out of the petrodollar system. That's when we deposed Saddam from Iraq, even though we put him in there in the first place decades ago. And then Omar Gaddafi, right, out of Libya, we put him in, right? He was a crazy guy. And, he stopped listening to us too. And then we attacked him and bombed Libya, right, when he stopped taking dollars for his oil and he tried to take other things, and he was talking about trying to form like a Eastern African like gold backed currency or something, right? So it's just pretty amazing all the things are going behind the scenes. When in doubt, it's about power, it's about money, and it's normally about oil.
Oh, definitely. The Mideast is solely about oil. It's definitely about the pipeline. I personally think it's, we're doing Saudi Arabia's dirty work.
Yeah, I actually read, did you see that interview where John McCain or one of the other senators said that he talked with one of the Saudi princes and they offered to pay for the whole war?
Yeah, that actually doesn't surprise me. I saw one of our guests, well, both of them have been former guests, but it was a Facebook comment, and I'm not going to say either of their names, but one of them was for Syrian regime. Actually, I probably gave it away. But the other guest isn't, and they were doing it on a status, and he said on the status that someone's going to pay for it. It won't be us. So,
well, it's going to end up being the U.S. taxpayer probably, right? Because the normal
he said it won't be the U.S. It will be someone else.
Oh, I disagree. It won't be the U.S. government. It'll be the U.S. taxpayer and the savers in the U.S. because the normal way, John, throughout financial history.
I never said I agree with him. I just said what he said.
Okay. Well. I'm not dissing you. I'm just in the comment that this other guy made. I'm not even sure who you're talking about. But we can talk about this off air. Anyways, though, the normal way wars get paid for is through inflation or taxation, and inflation is the stealth tax, and that's much easier. Because, if President Obama got in front, he went on national TV, told the American people, we're going to have to raise your taxes another 15 or 20% this year to pay for the war in Syria. I guarantee you the American people would revolt. I guarantee you the incumbents in Congress, in the House of Representatives and Senate, the ones that endorse that would get fired. But most of the American people are not very knowledgeable about finance and economics. They don't understand inflation, and they don't understand who's going to end up paying for the war. And if they're paying taxes, if they save in dollars or treasuries, they're going to end up paying for the war.
Yeah, definitely. I would say this is definitely a proxy war. This is China and Russia versus the U.S. We're doing the Saudi Arabia's dirty work. And Saudi Arabia, they are sort of hedging themselves where they're building that huge pipeline or refinery to sell to China. So I think Saudi Arabia is holding that holding that over the U.S.'s head, saying, we're ready to sell to China. We'd be more than happy to, have prices in their favor. But I think they're going to lose that swing producer status. And this also goes to show, if we had so much shale oil like the Department of Energy says, why do we even need to be involved anymore? Obviously, the Department of Energy is either lying or really incompetent, and there's another U.S. department that's refuting what they're telling us.
Yeah, John, doesn't Saudi Arabia and the Middle Eastern oil-producing countries account for over 30% of annual global oil production?
Yeah, they account for a good amount. I would say 30%. I know the U.S.'s largest importer is Canada, but Saudi Arabia, when it comes to, they're known as the swing producer for controlling prices. And they worked with the U.S. to help control prices to the U.S.'s liking. And that's what, as we all know, that's what Saudi Arabia is the reason the USSR fell. They're not the main reason, but they and Volcker worked together and crashed the USSR. So,
because they went. John, talk about the book where you learned about this. There was a documentary too, an oil documentary, and also a book about that.
Oh, the Saudi Arabia.
No, Houston, We Have a Problem, I think, was a documentary, and the book was the oil card game or something, or...
Oh, that was the Cold War. What happened was, in 1979, of course, the inflation was done on purpose, and what happened was, that was there to dupe Russia into investing in very expensive oil fields. And that's why Russia's a big producer today. They've always had that oil, they just needed higher prices to get it out. And so the U.S. loaned the USSR boatloads of money. They drowned them in debt. And they did it, and Russia was borrowing this to invest in their oil fields and produce, and they figured they'd get that money and revenue back. So what happened is Volcker, as our audience probably knows, raised rates drastically. And then in 1985, a swing producer battle began. Russia wanted higher prices. Saudi Arabia wanted lower prices. So what happened?
And Russia also leveraged too, betting on they leveraged their country's balance sheet. The Soviet Union did, betting on higher prices, and then when the prices crashed, they had all this debt, and they didn't have the income to pay off the debt, and that's what eventually led to their bankruptcy, right?
Yeah. So what happened was, and it was actually somewhat of a proxy war because Norway was on the USSR side because they just got the North Sea, and so they sided with Russia.
And that was higher cost oil, yeah.
And Saudi Arabia, they had friends like Mexico who wanted lower oil. I forget why Mexico wanted it. I think Mexico just, since the U.S. backed off its threats after it nationalized, that the Mexicans' government sided with Saudi Arabia. And a lot of the Arab countries, they didn't want to give up their power in the oil market. So it was basically the new kids on the block, the North Sea and the USSR versus, the Arab oil kings. And what Saudi Arabia did was in 1985, they doubled oil production to over 9 billion barrels a day. And that crashed the oil market. And a couple years later, Russia defaulted on their debt. They realized they couldn't pay it. And that's how the USSR crashed. And that's what happened. And so now we're starting to see a little bit of that again, the Russia versus Saudi Arabia. This time, instead of oil, it's natural gas versus oil, instead of who controls the oil price.
Yeah, and it appears that Russia is a little bit more well-prepared along with China because they're putting most of their physical reserve, trade surplus in physical gold. They're running their finances a little bit better than in the past. Whereas, the developed world, I make a good argument that the entire developed world, the United States, Japan, Europe, United Kingdom, they're all bankrupt. Okay, now Germany is in a good situation compared to the rest of Europe, but if Germany's going to have to try and hold the rest of Europe up, they're going to go bankrupt too.
Yep, it looks like a changing of the guard. So.
Yeah, so let's wrap up this podcast for our listeners here. We'll summarize a few of our main points. We still see worsening stagflation in the real economy here in the United States, and I would argue all over the globe. It's different degrees of stagflation all over the globe, depending upon how much market intervention the central planners have done in their own economy, how much games their central banks and politicians and bureaucrats have played with taxes and monetary policy and interest rates and those types of things. The U.S., most of the jobs being created besides shale and some manufacturing jobs are coming back and some technology jobs. Almost all the jobs are part-time jobs. There's still a lot of workers being fired from full-time jobs and hired back as part-time to deal with Obamacare, so corporations don't have to pay humongously increasing healthcare taxes, healthcare benefits, which basically turns into a tax. Let's talk about so the jobs report's really stupid, and we think that means that the Fed may try to taper, but it would be really stupid. We see foreigners. I think it would be absolutely stupid for the Fed to taper. Although in a free market, they shouldn't have even had the right to even be doing all this quantitative easing. I think the Fed's probably going to have to reverse course. The inflation is really bad in developing countries. This will eventually be imported back to the United States and the developed world through higher price goods and services. This is guaranteed. It's a question of when and not if. May take 18 months, may take 2 years, etc., etc. And, foreigners are just starting to dump the bonds. So if the Fed is going to plan tapering, who's going to buy the bonds then, John? Because the bond market is still about supply and demand. And if demand from foreigners for the treasuries, even Hong Kong, which was on a U.S. dollar peg, is starting to dump, and I think they're going to get off their peg because they have really bad inflation there. So if demand is dropping, who's going to pick up the demand then? And I think the only game left in town then is probably going to be the Fed.
Yep.
Okay, and I think we outlined stuff on Syria, talked a little bit about the oil market. Gold and silver are just in a trading range. In terms of the fundamentals are still very strong and getting stronger. I think we may build a little bit of a technical base around these levels. We could retest 1350 for gold. And, we may be in a trading range for a little while longer, maybe another month or two. And then, after this range is very strong, we're probably going to, because we have put in a higher base, I think we're going to start moving higher. Now, I don't think we're going to have any spikes per se, but probably an escalator move.
Yeah, it looks like an escalator move. I think the bullion banks are net long, but in order to keep it from breaking out, they can always sell and liquidate and profit take, and that would cause a slower escalator move. So,
yeah, I mean, people were calling us stupid and saying we didn't know what we were talking about when we were telling people to start averaging down on silver at $18.50, $19 an ounce, when gold was around $11.80, $1200, and we were just telling people about the production cost of the miners, that this was a market where demand for the physical metal, especially gold, was rising very rapidly, and there was about to be supply issues because a lot of the miners were about to turn off their supply. So that could not continue indefinitely. If you bought around those levels, you did extraordinarily well so far. Even if you average into positions and you have other losses, over the long term, you're going to do very well buying gold around $11.80 or $1200 and silver around $18 or $19. I don't think we'll see those prices again, but if we do, hopefully I have cash and I could be a buyer.
Yeah. Well, I was just going to say, and averaging down is the best thing, because when I was with my dad's money, I bought silver wheat the day silver went down to 18. I didn't know I was buying at the exact bottom, but I just saw good value, and I said, do a small purchase here. So dollar cost averaging does work.
Exactly, John, and I think that position is probably up at least 25-30% already, right?
I think it's like 35 actually, but.
Yep. And most people still aren't talking about gold and silver stocks. Most people still hate them. So there's a lot of wall of worry left in this bull market. One of the things about this 2-year cyclical bear that just ended was that, it took all the speculative froth, all the over bullish sentiment out, and it gave us one thing about a long-term bull market that you want a wall of worry. And it does shake out the weak hands. The people who bought gold at $1,500 and rode it up to $1,900 and were out, they're not long in this market again. I guarantee you they're not. Or most of them are not. And, they're not going to come back in this market for a while, but they will eventually come back because those people chase chart patterns and technicals. And we're going to be making higher highs than 1900 as long as these central planners and Keynesians all over the world, and it's not just in the U.S. or in Europe or Japan. It's in every country because they're all from the same playbook, John. They're all Keynesians. They all keep doing stupid Keynesian policy.
Yep.
Okay, well, just want to thank our listeners for listening to this podcast. If you have any questions that you want answered on a future podcast, or you want a free copy of our oil report that we wrote last year, but things are starting to play out in the oil market almost exactly the way we predicted them, and there's a lot of dividend stocks and good value in the oil market still, that we think longer-term investors who are willing to wait at least 2 or 3 years are going to get amazing returns.